With the specter of rising inflation, interest rates, and an impending recession, anxiety about the future of investments and financial stability is palpable. However, what if we told you that economic downturns are not just challenges, but also golden opportunities to amass wealth? In this video, we'll explore Warren Buffett's perspective on the 2024 recession and unveil the strategic investments that could pave the way for financial prosperity. Recessions, according to Warren Buffett. To set the stage, let's first address the fear associated with recessions. Warren Buffett, often hailed as the Oracle of Omaha, asserts that recessions are inherent in economic cycles and, despite their challenges, present extraordinary opportunities. Buffett, with a net worth of $120 billion plus, emphasizes that economic downturns are when the rich thrive, positioning themselves strategically to capitalize on the market's volatility. Now, let's examine a revealing chart illustrating the S&P 500's returns during both bull and bear markets. The pattern is clear. Every market crash is followed by a robust recovery. This historical data underscores the potential for smart investment decisions, even in challenging economic climates. Predictions for 2024. Moving forward, let's delve into the predictions for the next 3 to 6 months. Key factors such as potential layoffs, wage cuts, and decreased asset values are anticipated. Global events like climate-related disruptions, geopolitical tensions, and corporate downsizing contribute to an elevated risk of recession. Bank of America forecasts 175,000 job losses per month in the United States, and specific companies including Nokia, Paramount Global, Rolls-Royce, and Stack Overflow have already initiated substantial layoffs. Investment opportunities. Now, the crucial question arises: how can you turn these challenges into opportunities for wealth creation?
They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation. That's one reason real estate in general is good during inflation. If you built your own house 55 years ago like Charlie did, or bought one 55 years ago like I did, it's a one-time outlay. Whereas if you get an inflationary expansion in replacement capital without having to replace yourself.
Real estate opportunities. Real estate, often considered a reliable investment, undergoes significant variations during economic cycles. While national housing prices may see a decline, it's important to recognize the nuanced nature of real estate markets, which vary significantly by location. Over the past 6 decades, instances of nationwide housing declines exceeding 15% have been rare. Analytical insights suggest that certain vulnerable markets, including areas in Florida, Arizona, Idaho, and Southern California, might experience declines of up to 30% from their peak. This downturn, anticipated to last around 2 years before stabilization, presents a unique window of opportunity for potential investors. Homeowners with fixed-rate mortgages intending to stay put for the next 5 to 10 years might not be significantly affected. However, for those considering property investment or new purchases, this recession could unveil appealing opportunities to enter the real estate market at more favorable prices. 2. Cash as a safe haven. In times of economic uncertainty, cash, historically perceived as a less than ideal asset due to its tendency to lose value against inflation, emerges as a safe haven. This shift in perception is notable, with fund managers currently holding the highest levels of cash since 2001. The wisdom of maintaining a dedicated emergency fund is underscored, encompassing at least 3 to 6 months' worth of living expenses, including rent, utilities, food, and medications. Having a cash reserve provides both security and the freedom to exploit investment possibilities as they present themselves. Citigroup even suggests that cash can serve as a hedge for investors during a recession. This strategic allocation to cash enables investors to take advantage of opportunities when other assets face declining values. 3. Gold as a recession-proof asset. Historically, gold has been regarded as a tangible asset that tends to retain or increase in value during recessions. While this trend might not be universal, there have been instances, such as in 1973, 1974, 2002, and 2008, where the price of gold rose significantly during stock market downturns. Investors often turn to gold as a sensible asset during economic turmoil, viewing it as a bet against the dollar when confidence in the Federal Reserve is low. Joseph Sherman, CEO of the Gold Alliance, notes that during recessions, when paper assets like stocks and bonds are depressed, individuals and companies tend to seek the safety of gold. This surge in demand contributes to the appreciation of gold's value. However, it's important to note that while gold can be a prudent short-term investment during turbulent times, Warren Buffett, in his characteristic long-term approach, cautions against viewing gold as a productive, income-generating asset.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
4. Stock market strategies. The stock market, a realm often characterized by volatility, experiences declines during economic downturns. Recent data from major indices indicates declines ranging from 15% to 30%, and projections from financial institutions like JP Morgan and Goldman Sachs suggest the possibility of an additional 20% drop. However, historical data since 1946 reveals that bear markets tend to precede bull markets, and the most opportune moment to anticipate recovery is often when investors capitulate. Recognizing this pattern, strategic investors view market declines not as setbacks, but as opportunities to acquire assets at discounted prices. The concept of buying low and selling high is exemplified during economic downturns. As Warren Buffett famously states, "Be fearful when others are greedy, and greedy when others are fearful." Seizing the opportunity. To seize the opportunities presented by the impending recession, consider the following strategies. 1. Hold cash. Maintaining a cash reserve of 15 to 20% in your portfolio is not merely a defensive move, but a strategic one. It provides you with the financial firepower to capitalize on unforeseen investment opportunities that may emerge during the recession. The ability to act swiftly when others are hesitant can make a significant difference in the returns on your investments. 2. Cut expenses. As economic uncertainty looms, scaling back expenses becomes a prudent move. Adopting frugal practices, diligently tracking expenditures, and implementing cost-cutting measures can contribute to building a robust financial safety net. This safety net serves as a cushion, offering you the flexibility to navigate through challenging times without compromising your long-term financial goals. 3. Secure your job. In times of economic downturn, job security becomes paramount. Companies often resort to layoffs as a cost-cutting measure, making it essential for employees to enhance their skills and demonstrate their value to the organization. Investing in continuous learning and showcasing your indispensability within the workforce positions you as a valuable asset, reducing the likelihood of being targeted during layoffs. 4. Diversify investments. Diversification is not just a risk management strategy, it's a blueprint for resilience, including a mix of assets such as large-cap stocks, international stocks, real estate, and passive income-generating investments in your portfolio enhances its ability to weather market fluctuations. The old adage, "Don't put all your eggs in one basket," holds true, especially during economic downturns when certain sectors may face more significant challenges than others. 5. Long-term investing. Embracing the philosophy of long-term investing is a cornerstone of Warren Buffett's success. The temptation to time the market or make impulsive decisions during recessions can be strong, but history has consistently shown that markets recover. Regularly investing, or dollar-cost averaging, has been a successful tactic. enabling investors to benefit from market rebounds over time. As Warren Buffett advises, stocks should be viewed with the same long-term perspective as owning a farm, a commitment that withstands short-term market volatility. While the 2024 recession may pose challenges, it also presents a unique opportunity to build wealth. By understanding the dynamics of economic cycles, heeding Warren Buffett's timeless advice, and adopting strategic investment approaches, you can navigate the recessionary waters and emerge not just unscathed, but richer than ever.